Hello. In this short video, we will examine a handful of the exhibits from Chapter 6, along with a look at an income statement and the calculation of gross margin percentage, also known as gross profit percentage. First, let's take a look at Exhibit 6.1. This rather complicated looking chart just illustrates how bottom line net income is derived. We see net income on the far left. If we take a look at the far right column, we see all the various accounts that make up a typical income statement moving from top to bottom. Focus on the top right hand box where we see revenues and expenses that are related to operations. Remember, operations refers to the dollar values directly associated with the sale of products and services and the expenses associated with those sales. Investors who are external to the firm are often very much interested in bottom line net income. However, internal stakeholders, business directors, managers, CEOs, etc., are very much interested in how effective the business is in meeting its goals, which occurs through the management of expenses in operations. Okay, now let's spend a few minutes looking at an income statement. Here we see Exhibit 6.2, which is the income statement for Cisco Systems. So first notice that we see the full income statement from top line sales to bottom line net income for 3 years, 2009, 2008, and 2007. The item in yellow is operating income, which is highlighted. So again, as we mentioned just in the previous slide, internal management is very much interested in the operating income figures, which represents the effectiveness and efficiency of Cisco in managing expenses. Now I've taken the figures, the primary figures for 2009, and I've transferred them here into my spreadsheet. So we see the sales for 2009 of $36,117,000. So all of these values that we're looking at are transposed from the income statement. So we want to focus on the yellow boxes. First, we see a dollar column and a percentage column. Okay. And so the calculation of gross profit or gross margin dollars is simply top line sales minus the cost of those sales. So we see a gross margin or gross profit of $23,000.94. Now let's take a look at the percentage column. First, understand that top line sales for any company on any given income statement is always going to be 100%. And so we are very interested in these percentages. So for example, what is the gross profit margin percentage for Cisco for 2009? Well, it's simply the gross margin dollars divided by top line sales, or 63.9%. And so we do the same for cost of sales. We take the cost of sales figure and divide that by top line sales. And so we see a percentage of 36.1%. And so 100 less 36.1 is 63.9. And what that means is for every dollar of sales, Cisco had almost 64 cents of gross margin left to pay for operating expenses, taxes, associated operating expenses, and bottom line net income. And so the income percentage then for Cisco is bottom line net income divided by top line sales is 17%. So of every dollar in sales, Cisco shows 17 cents of net income. At this point in the presentation, we'll move into methods of recognizing revenue. And so here we start with Exhibit 6.3, which uses the installment method to recognize revenue and the associated expenses. So the installment method uses the gross margin or gross profit percentage of the firm to allocate gross profit and expenses. So for the example in the text, this particular firm has a gross profit margin of 35%. So the revenue is collected in years 1, 2, and 3, all by the installments. And in year 1, then we account for 65% of revenue as expenses, which is $1 less the 35% is 65%. So in year one, we see $20,000 of revenue. We account for we record $13,000 of expenses and $7,000 of gross profit. So again, those values are based on these two percentages, 35 and 65. And so notice that these two percentages always must add up to 100%. Now we take a look at Exhibit 6.4, which is the revenue recognition method using the percentage of completion. Percentage of completion method recognizes revenue in the proportion to which project-related expenses are incurred. So in this example, we see $7.5 million of total expenses. The firm anticipates recognizing $4.5 million in year one. So 4.5 divided by 7.5 is 60%. We do likewise in year two for 40%. So therefore, we recognize 60% of the revenue in year one, and we recognize the associated expense, and so $6,000 less $4.5 million is a gross profit of $1.5 million. We do likewise for year two. And notice when we add these values up, we have the sums that represent the revenue and associated expense for the profit, and the difference is returned to the firm in gross profit. Now let's shift our attention to accounts receivable. And so in this particular case, now we're shifting from the income statement, which dealt with revenue recognition and expenses, and now we take a look at a balance sheet item. So accounts receivable are shown on the balance sheet. And this is an example of a receivables collection schedule which accounts for the risk inherent of offering credit to customers. Right? And so the firm estimated that certain percentages of accounts will be deemed uncollectible. Right? And this pattern is typically based on estimates of past collections. So it's based on the history of accounts receivable collections. So in this particular example, the firm anticipates that 3% of all accounts between 1 and 60 days past due will be deemed uncollectible. Therefore, we have a balance of $30,000 in the category 1 to 60 days past due. We deem 3% uncollectible, so we estimate that $900 of that $30,000 will be estimated as uncollectible. So we make those extensions for each category of age of accounts receivable, and we see now of the $100,000 receivable balance, the firm estimates that $2,900 will be deemed uncollectible. Next, we must figure out how to record this in a proper accounting entry. Okay, so this image shows how the $2,900 of accounts receivable deemed uncollected is recorded. So we show an expense of $2,900 here on the income statement, and the corresponding entry on the balance sheet is a contra asset, which is the $2,900, which is actually deducted from accounts receivable, but it's shown in this contra asset account. Here we have the journal entry and of course the T account entry for that transaction. Finally, we see what this would look like on the balance sheet. So Exhibit 6.7 illustrates the actual value that would be shown on the balance sheet. Notice the firm reports accounts receivable on the balance sheet at a value net of allowance, so the value is $97,100, right, which anticipates what will actually be collected and accounts for the risk and realities of offering credit to customers. This concludes the video on revenue recognition, accounts receivable, and a look at the gross profit margin calculation on income statements. I hope you found it helpful.